Do we have some complacency in the US equity market? Well, let's look first at what we mentioned a month ago. We looked at here the S&P 500 on March 18, and we suggested three different paths. One of the paths, the violet one on the top part, was rising into a wide wedge, but was taking its time, was supposed to take its time during the rest of March and April. What did happen? As we can see on this chart of April 16, you see that prices have risen even above the rising wedge in black here. And it has accelerated in a more linear fashion. At the same time, if we look at the top part of the panel, we notice that the rise of the S&P was going on with an increasing rate of increase of the Nasdaq. As you see, the relative strength of the Nasdaq versus the S&P, the red line, is rising even faster. On the other hand, relative strength of emerging markets are kind of flat versus the S&P 500. And the rise of the equity market is focused on large cap. How do we see that? We see that on the green line, here the dotted green line, which is coming down in the last 4 weeks. That means small cap are underperforming large cap. Also, during these last 3 weeks, we noticed that the volatility has also declined quite a lot. And the momentum remains relatively in the overbought area here on the lower part of the channel. If it's above 80%, that means the market is strong, and that's exactly what's happening. Market is rising regularly every day. Now, a week later or 2 weeks later, when we discussed that last time, we suggested, as the market was relatively strong, that we could have, within the coming weeks, a new pattern above our formerly black shaped wedge, namely a blue wedge. And this blue wedge was rising faster at a steeper ascent than the previous one, and it was suggested around April 2nd that it would go on toward 2900 area, then pull back eventually and eventually reach 3000, who knows. But let's look at what happened then since. In fact, the market has been showing very little volatility. As you can see here, from the beginning of April to right now, about 15 days, we had very small movement, all capped by the resistance trend line here, and no pullback of any importance. Momentum is somehow still showing that it is a strong market, but slowing down a little bit here. And we notice that that has happened during the time when here the interest rates of the 10-year US market has been stopping declining as it was in March, but is rising a little bit. And that has, of course, favored what has been recently mentioned in the press, namely a relatively good good performance of financial versus the S&P 500. So, what do we expect next? Can it go on forever along just the resistance trend line? Does it need to pull back? Let's look at the volatility here, the orange lines, and that in more detail. Here we've got the VIX, which is the 1-month volatility measure, or the fear index, if you wish. And we notice that compared to what happened in December, where the volatility was 36%, now we are very much at the bottom of the range, close to 12%. In fact, if we closely looked at previous past, namely in August of 2018, or even in December of 2017, we notice that we have two key levels. Number one levels of 2018 is about 12%, or maybe 11.55, as I put on the chart. And the other one, that was the old low volatility area before 2018, and that was around 10 to 11.5%. So the real question is, are we coming to a point where it is too much complacency? That means nobody cares about any pullback in the market, and nobody care about hedging part of the rise of the equity market. There is no turnaround yet. If you look here, you have only black bars. That means every week here we are making a lower close, and that means volatility continue to decline. But as we are on these key levels, here we need to watch what their momentum is, and that's on the lower part of the chart, and we notice that it is clearly on the oversold area. That means momentum is coming down, but probably not so fast as it used to come down in the first part of the year. What is also the volatility for 3 months outright? Are there any fear here? Well, we noticed here this VIX, which is a bit higher levels, of course, because you pay a higher insurance premium for a longer time than the VIX. And we also show on the upper part the ratio of the VIX 1 month versus 3 months. And of course, when things get hot, you know, like in December, well, the ratio of 1 month, your insurance premium for right now, because something is hot, is much more expensive than the volatility that you would price later on. And you've got these kind of spikes. And of course, when everything is quiet and nothing moves, most of the time this ratio is at lower levels. And you see that, for example, in September, it went all the way down to 0.80. And now we are close to these levels of this 80 ratio and far away from the excessive ratio of 120 or 1. So here, same story as before, right? We are close to new low. That means people are close to not paying any price for insuring their portfolio. And the question is it too much complacency? When will it turn? And we can look to get an answer at another interrelated market, namely the US dollar index. And if we look at the US dollar index, what we noticed here on a weekly basis is that we have a big triangle delimited by the red lines here rising slowly, right? And the top has been defined quite neatly over the last 6 to 7 months at 97. Currently, and we noticed in the last 3 weeks here, the dollar was from the middle of the range and went down a little bit. A dollar which goes down has been helping even the S&P accelerate upwards, right? A dollar coming down is better for the export industry in the US and the large caps, which have got a lot of revenue outside of the US. So that makes sense. Now, what tells us the technical pattern? Technical pattern tells us that a rising triangle usually goes into a continuation pattern of the previous move. What does that mean? That means that if we look here in the beginning of 2018, here, it has been moving up, then consolidates, so it's expected to move up again. At least as long as it doesn't break the support here, where it seems possibly to rebound. So a little rebound of the US equity could lead, maybe, in the coming days or weeks, to some pause in the equity market. And if it goes too far up, that would be trouble. If, on the contrary, the dollar failed to rise right now and start to move down against developed currencies, then it will help the US market. We'll see you in 2 weeks and have a very happy Easter.